Welcome, everyone. Thank you so much for coming out today, trying to avoid the heat and eat some donuts this morning, huh? So the reason I titled this Kick the Can Down the Road is because isn't that what we all want to do? Nobody wants to pay taxes come either April 15th or October 15th, wherever it's time to pay. And this is actually a legal way to do that, just kick that can down the road. So I'm going to just start right off. I'm sure that most of you in the room know what an exchange is, but there may be some people that decided, oh, I see that there's something about exchanges. So this is actually the code section that tells you exactly what an exchange is. And there's very important things in there. If you'll see, I've highlighted real property, and then it's held for productive use in the trade or business or for investment, and it's got to be exchanged solely for real property of like kind. And we'll talk about like kind a little bit later, but those are very important parts of the code section. A little bit about myself. I came from the legal profession. I worked for 32 years solely as a paralegal, except for a short stint as athletic director and PE teacher at St. John's when I got really tired of being around legal people. But I did specialize in business formation, acquisition, sales, mergers. I did a few 1031 exchanges, and I'm going to give credit to Billy Sue here, who actually came to Klein Natali and taught me everything I needed to know to be able to do it from that side. I was so thankful to her way back in the day when she did that for me. I also did business and farm reorganization. I do have a special love for farmers. I really, really do recognize that our farmers, they work harder than anyone that we know, and they never get a day off. And one of the reasons that I decided to make the transition was a lot of my dairy farmers weren't able to reorganize. And some of you in the room might be representing dairies that are being sold, and it's a very sad situation. So if they're able to be successful and sell and do 1031 exchanges, awesome. But if I'm having to bring dinner to their house, it's just not a fun thing. I was also involved heavily with the Paralegal Association and just actually stepped down as president. So who's Mission Bank 1031 Exchange? Well, we've been around for 15 years, and in 2 days, it's going to be our 15th anniversary. And we do offer qualified intermediary services for 1031 exchanges. I guess that's a simple way to put it. And why should you or your client, I guess, retain a qualified intermediary? And it's because they really need to do that so that your client won't have constructive receipt of the funds. Because if they do, it's not going to work out very well for them. Early on in my career, I had an elderly gentleman come into the bank, and they called me to come out and talk to him, and he had a check in his hand. He had just picked it up from escrow. And he said, I want to do an exchange, here's the check. And I had to say, I'm so sorry, sir, but that's constructive receipt. And so it's very important that you do get your client involved with somebody like myself before they close escrow. It's super important. Okay, there's different parties to an exchange. So I'm going to start at the beginning. Who's the exchanger? It's your client. And they range in age, they range in expertise. Some of them have done a jillion exchanges. They know everything about exchanging. And then there's the other people that just don't know anything. And there's a lot of those out there. There's a lot of mom and pops that have, maybe a small business or maybe a rental or two. And it's actually sometimes I should have put the title company on here too, because the title company is the one that says, oh, this is an investment property. Have you thought about doing an exchange? Which they can't give advice, but it's so nice of them to bring that up and give them that opportunity to kick that can down the road. So I just put a few pictures up here because these pictures actually represent the type of client that I have worked with over my almost 3-year career. Okay, next is you, the real estate professional. Okay, so you're a very important part of this because you're the one that represents the client that's selling their property. And I don't do that. I don't write their purchase agreement. You do that. It's very important. Now, it's not imperative that you put language in your purchase and sale agreement about the exchange, because I'm going to provide notice to all parties in the exchange. But I did put some information up here just to say, you know, buyer is aware that seller intends to perform a 1031 exchange and agrees to cooperate with seller at no cost to buyer. Buyer agrees to the assignment of this contract to the qualified intermediary retained by the seller. And there is a CAR form that is a 1031 form, so you can use that form as well. But people do call when they know that their client is going to do an exchange, and I just kind of babble this off to them and say, yeah, you can just say something like this. But I always urge you to talk to your legal department, your CPA, before you just adopt language in your contract. Don't just say parents said it. Okay, the next person that's part of the exchange is the CPA. I could have also put /attorney, and my previous employer probably wishes I did. But the CPA is crucial to this, because guess what? I am not a CPA, and I don't want to be a CPA. I took those classes in college and couldn't do it. I need people. I need people more than numbers. And but the CPA is crucial, because they're the ones that can tell your client, okay, you want to take $10,000 out to pay for your daughter's wedding? Great. This is how much it's going to cost you to do that. Or you need to put everything into the exchange, and here's why. And I do urge people when they call me and they're trying to consider, should I exchange? Shouldn't I? I always say, call your CPA. Have them crunch the numbers for you, because if they crunch those numbers for you, you're going to see the cost analysis of whether or not you should do an exchange. It's really, really important. Oh, and there are people that are CPAs out there that never do exchanges. And so you do want to make sure that your client does speak to somebody that is knowledgeable about exchanges. And then finally, there's the qualified intermediary. And the role of the qualified intermediary is essential, because you have to have that party that is neutral, that is going to hold the funds during the exchange. They have to be, so I wrote up here, what qualifies the qualified intermediary? I think it's easier to say what disqualifies. You can't be their own attorney, their accountant, their realtor, their banker, their attorney, if you've worked with them within 2 years. So you have to be disqualified in order to be the qualified intermediary. Escrow is not a qualified intermediary. I should have, like I said, I should have put the title company up here, because they're also important part of the process. But they handle escrow, they do the deeds, they transfer the title. But then when they get the money, they transfer it to the qualified intermediary who holds the funds. It's a whole separate part of it. So I apologize that I didn't put them up there. I'll add that in for my next presentation. I think that it's really important that you find a qualified intermediary that is competent, that has integrity, and that you know there is financial strength in where they're putting your funds. Because this is a largely unregulated business. There are people out there that can just hang up a shack and say, I'm a qualified intermediary. I'll do your documents, give me your money. And yes, the state of California does say that you have to have a bond and you have to have insurance. But most people, and I shouldn't say most, some people, when they call up to talk about exchanges, what's the first question that they ask me? What do you think the first question is, sir? The fee. How much do you charge? And especially when it's somebody that's calling for their parents, their elderly parents, and they're helping them, and the first question, how much do you charge? And I tell them, I said, you know what? That should not be your first question, sir. You want to know that your parents' money is going to be safe. And it doesn't matter if it's $100,000 or if it's $100 million. It's very important to your parents that their money is safe. So I always urge people not to shop for fee and to shop for financial strength, knowing that the person who is going to be holding their funds and helping them with their transaction has integrity, competence, and financial strength. So with us, of course, the money is going to be held at Mission Bank.
So I just want to bring up something like that has happened to my client like 12 years ago. It was an intermediary company, whatever they call it, and actually was fraudulent. And we had to go through legal stuff and try to, I don't know what exactly came out of it, but it is very important if you deal with somebody local.
Thank you. Well, there you heard it. So I just wanted to let you know, this was me behind the scenes 30 years ago. I used to do Ironman triathlons. So I had a lot of fun doing that. I actually moved to town to run track and cross country for CSUB. And I did that. And this was back when triathlons weren't very popular. And I thought that the few people on the team that did them were crazy. And then I got injured and had to do some swimming to recover and then some biking to recover. And the next thing I knew, I was doing a local race. And then it blossomed into, the most I ever did was 3 Ironman in 1 year. That was the last year I ever raced. I retired and went full-time working after that. Yeah, started having babies. So what are the QI responsibilities? QI and QI, Qualified Intermediary, Accommodator, those are all synonymous terms. So what we do is we prepare the contract with the exchanger, and notice I underline, before escrow closes. It's very, very important because you're assigning the contract to the company to effectuate your exchange. So they work with escrow, they prepare all the documentation, they control the proceeds, and this is very important because you don't want to trigger the capital gain with constructive receipt. They monitor the exchange, identification, replacement timelines to ensure that they're strictly met. We'll talk about those timelines a little bit later. And then they coordinate details with escrow and closing agents to document the transfer and the replacement of the property. Uh-oh, can you turn it off? There. Okay, CPA, because again, we all have different responsibilities. So as I told you earlier, the CPA, they're going to monitor the transaction to ensure that the 1031 exchange meets all the requirements. They're going to provide the tax advice. I'm not going to provide the tax advice. Please don't call me and ask me for tax advice. And then they work together with the exchanger and the qualified intermediary. We're really partners. So what are the types of exchanges? And I'm going to go through these kind of quickly. There's a simultaneous exchange. It does happen sometimes. It's kind of rare. And you guys in the room know that it's very difficult to close escrow on one and transfer the funds and buy the other one all in one day. So that's why that one is sort of rare. The most common is the delayed, which is they sell their relinquished property and then down the road they buy the replacement property or properties. They can buy more than one. There's build to suit, and this is actually getting to be sort of popular because it's hard to find what you want. And so people want to buy their land and build, but they want to sell their building to use the money to build over here. So we can accommodate that too. And then there's a reverse where they find that property that they just have to have. They haven't sold their other property. And so there are arrangements that can be made for that. Now, what you don't want to do is buy the property before you call a qualified intermediary, because that means you own the property and it's not eligible for an exchange. The timeline is, as I mentioned before, is really crucial. And there's probably people in the room that are going, I know this, Karen, but there's probably others that don't. So day one, you'd sell your property. Day 45, you want to identify, and you identify specifically by address, APN number, any sort of description that is imperative so that you can identify that property. And then on or before day 180, you close on the replacement. Now, you can close any time during that 180 days. You can close before the 45th day, but this is the longest time that you have available to you to complete your exchange, no matter which type of exchange you do. So this is the 3 ways to identify, and the most used form is the most simple form. It's just the 3 property rule form. So you've got 3 blank spaces, you write your addresses in there and you say, I'm going to buy 100% of that property, or I'm going to buy 50% of that property because I'm going to buy it with my sister. Okay. The next one is the 200% rule, and it's 200. You can identify as many properties as you want, so long as the aggregate total of the identified properties does not equal more than 200% of the gross of what you sold. And again, now that one's a little more difficult because you have to say how much you're buying, money-wise and percentage. So it gets to be very important. And I have people ask all the time, Lisa probably does too. Well, I want it to all fit. So can I say I'm just going to pay 500, even though I'm probably going to have to pay 7? No, you can't. If you want somebody to tell you, yes, I'm not your girl. I'm just not. Then there's the 95% rule form. Now, this one is rarely used. Yeah, Billy Sue's shaking her head too. And again, I'm in a room full of realtors, so you guys know why. If you identify 12 properties, you have to close on 95% aggregate of those during the 180 days. And if you miss it by one, you're done. Failed exchange. So we don't see that one used very often at all. So why do people choose to exchange? And the number one reason, get that can down the road, right? I mean, who wants to pay taxes? But there are people that are moving out of California in roads. And guess what? They want to take their investment property with them. I can't tell you how many people have sold their 4 rentals and their personal family residence and moved to Texas. And I handled their exchange and they're gone. And now all their properties in Texas, Tennessee, Montana, Florida, you getting the trend here? Idaho. So relocation, they want to consolidate. Some people have, 4 single family residences and they want to buy one bigger one so that it's less headache. They don't have to deal with 4 tenants. But one of the things that people don't realize is 231 actually does stimulate the economy. And I think this is something that we in the industry really need to think about. And there's a couple of studies that have just been redone by the, I'm a member of the Federation of Exchange Accommodators, and there's a consortium of mortgage brokers, realtors, bankers, title companies that have all been working together behind the scenes to save 1031. Because as we probably all heard, President Biden ran on a platform that said, let's get rid of it because the rich are getting richer. And, we don't want to just let these people get off without paying taxes. Well, it is not true. It is not true. And so Ernst & Young did a macroeconomic study and Ling and Petrova did a microeconomic study. Both of them came to the same conclusion that it actually stimulates the economy and that if we get rid of it or we diminish it down to, the last time I heard is 500,000, no more than 500,000 gain, it's going to slow economic growth. It's going to reduce our real estate prices. It's going to keep people from working because 1031 creates jobs. Those exchanges that I talked about, the construction exchanges, think about all the people that are involved in working in construction. Think about the banks that are lending the money. Think about the title companies that are handling all of that. So a lot of us in this room, if 1031 goes away, it's going to really make it a lot harder on us to make money. And if anyone's interested in those studies, please reach out to me and I can give you the studies. So what taxes are to be deferred through an exchange? Well, of course, capital gains. So depending on what bracket you're in, see, this is another question people call me, well, how much am I going to pay if I fail? Well, guess what? I don't know. I'm not your CPA. If you're in a low bracket, you won't pay. If you're in a high bracket, you're going to pay more. State income tax, same thing. In the state of California, capital gains is taxed as ordinary income. So it can actually move you into a new bracket. Oh, joy. There's also depreciation recapture, which can be taxed as ordinary income. And then for high net worth individuals, if you make more than $400,000 a year, you can pay the healthcare tax, also known as Obamacare tax. 3.8. So here is my rule of thumb. This is not tax advice. This is rule of thumb, okay? General rule of thumb. How can I fully defer my taxes? Well, first thing, you want to put your net proceeds into the exchange account, all of them. You don't want to pay your credit cards off as a part of the close of escrow, okay? Things like that. You're going to buy your replacement property for equal or greater value is what you sold, and you're going to spend all the exchange proceeds to accomplish that. And then finally, if you have debt on your property that you sold, you need to replace that debt in equal or greater value. Or if you have cash in the bank, fresh cash, you can put that in, because I know we all strive to be debt free, right? So if you do have money that you want to buy down the debt, you can do that. So simple little rule of thumb. Okay, now I told you we were going to talk about like time, and I get calls like this all the time. Karen, I'm selling a condo. It's been a rental for 10 years. So I have to buy a condo because I really want to buy a house. That's like kind. Like kind is anything that the IRS classifies as real property. And they classify things as real property that you and I would never classify as real property. Would you classify water rights as real property? You can do it. I've done it. Billy Sue probably has done it. Long-term, permanent water rights. Cell phone towers, those long-term leases, those are considered eligible for 1031 exchanges. There's senior living, there's commercial building. A lot of people like to buy triple net leases. All of these types of things are considered like kind. What's the definition of real property? We were just talking about that. So the IRS finally issued their final regs in end of 2020, and they defined real property. And in that, they also said it's going to be determined in the law of the state or local jurisdiction. So that is something that's a little bit different, because that means it can vary from state to state. And a lot of people are buying from state to state. So you do need to get good tax advice from either your CPA or your attorney when you're buying something that may be classified a little bit differently. The final regs also talked about machinery and whether or not it could be considered real property. And they determined that if it's inherently, permanently affixed or integrated, then it can be considered real property. So inherently permanent structures that are permanently affixed to the land, here's a little bit of guidance. The way it's affixed, whether it was designed to be moved or remain, the damage that removal would cause to the asset or to the real property. Circumstances that suggest expected period of affixation is not definite, and the time and expense to remove the asset. So structural components, also there's some guidance there. Same thing, manner, time, expense of installing. Was it designed to be moved? I like this one, number 4. Was it installed during construction? So all of these things can help you and your client when you're selling something that has machinery or things that are affixed to determine if it really is classified as real or personal property. And of course, they should always consult with their CPA, because their CPA has been keeping these things on the books, and they classified them as, guess what? Sometimes personal property. So you can't then go later and say, oh, I'm exchanging it now, it's real property. Incidental personal property. This one is a good thing for all of us, because who was it that said they were selling a business? Right back here? Yes. Okay, so sometimes you sell a business and you're really selling the real property, but there's things that go along with the real property that you're not going to move out. Just little things that are just normal and used in the business, right? So it is, if it's common to be purchased along with the commercial property and it's incidental personal property, then the final regs say that it can be transferred with the real property so long as its aggregate fair market value does not exceed 15% of the gross value. And you are going to still pay tax on that. Okay, your client's going to pay the taxes, but more importantly, it's not going to blow their exchange because they spent some of their money on personal property. Now, before this determination, the IRS, the Franchise Tax Board, they were free to kind of, decide on their own, did it blow your exchange, did it not blow your exchange? So it's very helpful for your client to know that they are safe, is so long as they use those numbers. There are other options that you may not be aware of. They're called Delaware statutory trusts. And there's also tenants in common. Now, you're probably familiar with tenants in common because if you and I buy a property together, because we're not married or related, we would say we're going to buy as tenants in common because if I should pass away, then I want my heirs to have my part and you want your heirs to have your part, right? Well, there are companies out there that buy really nice, big, $100 million property, and they will sell fractional ownership interest in that property to people like yourself or your clients, and they sell it as tenants in common. But there are also companies called Delaware Statutory Trusts that it's kind of interesting because you have to buy those through a certified financial advisor with a Series 7 license. Now, are you as a realtor going to get a fee on that? No, you're not. But it is good to know for your clients because in this type of market, it's hard to find really good replacement property. And because their goal is to kick the can down the road, you want to help them find the product that is going to work best for them. And I would say that in the past, before COVID, we used to use these DSTs as insurance. So let's say you really wanted to buy the Stockdale Tower. Okay, you just had your heart set on it. You grew up looking at that building and it's just beautiful. You want to buy it. But the guy that owns it might not sell it to you. But your 45-day is here and you have to identify. So he identifies Stockdale Tower, but then he's going to go to one of those companies that sell Delaware Statutory Trust and he's going to say, I've got $10 million. Not how much Stockdale Tower would be. You guys probably know better than me. But anyway, I've got $10 million and I'm going to buy the Stockdale Tower, but if it doesn't work out, what could I do as a backup? Unfortunately, because of the market and the way it is, you can't really use DSTs as backups anymore. But I just want you to know that it is an option for your clients. And there is actually one company that I've been working with that does not go through a certified financial advisor, and they do pay commissions to realtors. So if you would like to get information on that, I'd be happy to introduce you because in the end, I feel like I'm a bridge builder. I am an intermediary, so that's great, but that's part of my title. I'm a bridge builder. I'm here to listen to that client and to hear what they want and what would be best for them. And in the end, isn't that what you are also? I mean, yes, you want to get the sell, but you want to establish long-term relationships and you want to do what's best for your client. So it's always good. I think that education is just key here. And, just to be knowledgeable about all the different options that are out there for people, I think is amazing. So if you have any questions about that, give me a holler. This is another one. How long can I hold my property? Oh my gosh, call your CPA, right? I wish I just had a recording that said, call your CPA. But there are rules. Unfortunately, the IRS, because it is the IRS and they want to make sure that tax attorneys make a lot of money, they didn't say how long you're supposed to hold. But there is case law out there that does say that if you hold for 2 years, you should be safe. Okay, so another one is, and people ask me this a lot, especially those people that are moving to Texas and Tennessee. You sell a rental property here and I'm going to sell my rental property. And how long do I have to keep it as a rental until I move to Tennessee and just take it as my primary residence? Well, number one, don't write that down anywhere because the IRS is all about intent. All about intent. So those flippers that flip houses, they're not eligible for exchanges because remember, long-term use, that type of thing. So if you do have some sort of plan like that, keep it to yourself. You can think about it and you can know that maybe in your mind that might occur, that maybe you would move to that house after you held it for 2 years as a rental. But I can tell you there's case law out there that there is one that I thought was really interesting out of the Bay Area where the family owned a home that they lived in. They had children that were in high school. It was a fractured family. They didn't talk to their siblings. They actually didn't like their siblings at all. And they sold a rental, exchanged it, bought another rental. They put it on the market, nothing. They got 3 applications, none of them were good. And something happened along the way. I can't recall the specifics, if it was the wife or the husband that fell ill, but there was definitely a change in circumstance and they couldn't afford to keep the rental house and keep their house. So they had no choice. They sold their house and they moved to the rental. Well, of course, IRS was all over that. I mean, you only had the house for 6 months. What do you think you're doing? You moved right into that house. Well, it was a change in circumstance. They intended to rent that house out. That was part of their long-term plan. And even the fractured brother, that the relationship that they didn't even want to talk to, came to testify in court that he knew for a fact they never wanted to move while their children were in high school because they didn't want to force their children to change schools. And ultimately they prevailed. And it was not overturned. It was a valedictory one exchange. But who wants to go to tax court? I mean, raise your hand if you want to go to tax court. Not me. Okay, so just be smart about what you're doing. And here's what I say: stay in your lane. Stay in your lane. Stay in your lane. Everybody, we talked about who has what job in this process, and if we all stay in our lane and work in partnership, I think we'll all be successful. It looks like we have a question.
Real quick, for example, just the example that you just made right now, is it, say you move into that house and sell it 2 years from now, is that legal?
So, did you guys understand the question? He said, in the example that I just gave, could they have lived there for 2 years and then sold it, and is that legal? And they didn't exchange, right? Yeah, because it was their personal residence. So I think that they thought they get the exemption if they live in the house for the better part of 2 of the last 5 years. So I think that it would be okay, but I do know this. If you have a rental and you move into it, let's say you have a rental and you have your personal residence, okay? So you sell your personal residence, your rental's been a rental for a long time. You move into it, you live there for 2 years, you could sell it. Okay, I do know that. I do know that you have to hold the rental for at least 5 years if you didn't own it for a long time beforehand. Let's say you just bought it, rent it out for a couple of years, then you moved into it, you'd have to stay there 5 years because you just sold your other house and used the exemption. But again, talk to your CPA. They can help you with this. That's why, I mean, they struggled through those boring classes and they took all those tests. So they have the knowledge that we don't have. So I say, call your CPA. Thank you so much. If anybody has any other questions, it looks like we have one over here.
A long time ago, maybe 20 plus years, one of my sellers, he parked the money in his personal friend, and then he made an exchange. So is that rule still coming, or have you read about it, you know about it, that he did not go through any intermediary?
So your question is, he sold his property, he had his friend take the money. in the other friend's account. I think that would be a fail because he had constructive receipt.
He did not see the money, I know that. But he took the money from directly from escrow to his friend's name.
I know. I understand what you're saying. Did they have a written agreement?
Fine, I know.
Well, if you don't get audited, then you don't have a problem, right? I mean, we can all run the risk. I think that if they had proper documentation, perhaps that could fly. Billy Sue wants to weigh in on this one.
I was going to talk about it. You can have unrelated parties be your qualified intermediary. Karen mentioned earlier that a qualified intermediary is not qualified if that individual business has performed services for you, professional services for you in the prior 2 years of sale. So that friend has to be exempt from all of those. But if it did, I think it would pass audit possibly if it went to audit, but the documentation is what's going to be critical. I mean, the documentation has to be 1031 compliant. Did that friend go to an attorney and have them prepare compliant 1031 documentation?
Only one thing I remember is that he did not go to any intermediary. He went to the friend and he took money directly from escrow to his account. And when he made the exchange, he transferred the money.
And that's okay, as long as that friend is qualified to be the intermediary. But the documentation is what I would be really concerned about.
Well, the thing that I would be concerned about is, I don't know, if I told my friend, I'm going to sell my house and you're my best friend and I'm going to have the money put in your account. Well, if I told you tomorrow to move the money somewhere else, you're going to do it. So if I ultimately have control of that money, even though she's holding it, she's a straw man. She's just holding the money. I don't think it would fly, but that's just me. Go to your CPA. Yeah, and again, if you don't get audited, it went through, right? I mean, that's the thing. We all run risks. Just driving in a car, you run a risk. You're going to get there, you're not going to get there. So, I am one of those people that I follow the rules. And I just think it's a good way to be. I always ask my clients to follow the rules. I've had people call me and say, I'm going to identify this, and it's the 45th day, but it's not actually for sale, and the deal might fall through tomorrow. So if the deal doesn't fall through tomorrow, and I identified it, can you just rip up my identification form on day 46 and pretend like I didn't turn it in and give me my money back? And I say, no. I'm not an accommodating accommodator. I mean, I'm a helpmate. I will do anything I can for you, but I'm not going to perform tax fraud. And I mean, they think it's a simple thing. Rip it up. Well, I'm not going to do it. That's tax fraud. It looks like I have a question in the back.
Thank you.
So I have a question about a tax deferred exchange where it's not a 1031, but it's one of the, 1033, where like in the case of the West Side Parkway going through, if a government entity buys your property, not necessarily the eminent domain, but similar to, what are the timelines different? Do you still have to go through QI and all that?
The timelines are different. They don't have to use a qualified intermediary. They can if they want. Call their CPA, right? Okay, any other questions? Well, thank you so much for coming out and listening to this. And I do have business cards, but I'm really easy to find. Looks like I have one more question. He wants to know if I'll give him my slides, and the answer is yes. As soon as I can log into my computer, I tried to log in this morning to run through my slides so I would be prepared, and my darn VPN was down, wouldn't let me in, so I had to leave. So I hope you enjoyed the presentation. Thank you so much.